Rob, I know your phone's been ringing today. As you've been fielding calls and some hand-holding, what are you telling people?
Well, Adam, people are asking if this is a bear market and they need to bail out of stocks. And I tell you, looking at the yield curve, looking at strong corporate earnings, looking at the economic data, which has been bad, but still, it's all showing a slowly growing economy. So at this point, I see no recession, and I would say that's no bear market. So stocks will eventually find some bottom.
Now,
here.
I got to ask you say a slowly growing economy. Okay. The joblessness went down 0.1%, but if you look at GDP, if you look at consumer I mean, you know, there's some issues out there.
There are definitely some issues. Is a recession a possibility? Yes, but given the current data that we see, I don't see it.
And what if we just stay down where we are for another year, another 2 years, another 3 years? How do you get excited about stocks?
Well, I tell you, Adam, corporate America is so lean right now that it doesn't take a lot of incremental demand to get the whole virtuous cycle of hiring going. We had a head fake on this 3 months ago, actually 6 months ago. We had 3 great non-farm payroll reports. Then the slow patch hit. CEOs got a little nervous, and so now we're still kind of trudging along. But once that does hit, that's going to be good.
Hey, Rob, wait. I got to slow this down because you glossed over the economy, I felt like, really quickly. I mean, there's a lot of problems here. We spoke with Nouriel Roubini this morning on our air. He spoke, first of all, let's talk about the job numbers. He didn't find them so pleasing. Listen up, everybody.
Okay. Well,
the only reason why that unemployment rate didn't go up, it went down, is that 200,000 people left the labor force. If you look at the household survey, actually there were job losses. So the unemployment rate fell for the wrong reason, not because we're creating enough jobs to reduce it, but rather because people are becoming so discouraged they're leaving the labor force.
I mean, Rob, let's look at stuff. People are becoming really discouraged again. They're leaving the workforce. They're giving up. They're not even looking for jobs. Let me talk about the housing market. That's still a mess. I mean, how can you go over this so quickly and say we're not going to get a recession? Because it feels pretty ugly right now.
Well, sure it does, Carol. But and we do need to grow jobs by about 150 to 200,000 a month to really see the unemployment rate come down, which coincidentally did come down. But you got to look at, if we're going to get a recession, the yield curve's got to flatten or be inverted. It's very steep. Corporate America, profit-wise, it's just had one of its best quarters ever, and it's not doing it just by firing people. Revenue growth was up 11%. Is the economic data weak? Yes, but we didn't come up with a negative number today. The ISM number on Monday was actually 50.9. Very disappointing, but still showing an expanding economy.
Hey, Rob, what if all this growth that we've seen over the past 2 years, growth if you want to call it that, has effectively been the result of stimulus as opposed to consumers actually coming in and buying stuff?
Well, I think the fact, Adam, that corporate America this quarter saw that revenue growth at 11%, I think that's showing that people are buying stuff. Now, it's fair to say some of those people are in emerging markets overseas, but a lot of it's coming from consumers here in America as well. So I think we are seeing some of that demand that's not just government related from stimulus, as you pointed out.
Hey, let me throw another problem at you, Rob. I'm going to beat you up a little bit today because I feel like there's a huge wall of worry that we're trying to climb, and the wall just gets longer and bigger and wider. And I'm thinking about Europe, and I want to bring Julie into this because, Jules, we talked to Paul McCulley earlier today from PIMCO, and he had some things to say on Europe, didn't he?
He did have some things to say, and he talked about a concern over what's going on in Europe. And I also saw a note today from Michael Pond, who is a fixed income strategist over at Barclays, and he talked about needing some sort of concerted effort now on the part of central banks around the world in order to get all of this, all of the ducks in a row, if you will, or to try and reverse what we have seen. We're seeing some of that already start to happen in Europe, obviously, with the Italian ministers meeting and trying to figure out what the solution may be there. But Rob, what do you do when you throw that into the mix on top of everything else?
Well, I do. I'm glad to hear that central banks around the world are getting involved in that problem, and it's certainly something that needs global attention. At the same time, back to U.S. multinational corporate earnings. So many of those earnings come from overseas. They're not really. The growth isn't really coming from Europe. It's coming from the emerging markets. So Europe certainly has a higher likelihood of hitting a recession than the U.S. If that happens, I don't think they drag us in just because the emerging world is still moving right along from a revenue standpoint for U.S. multinationals.
All right, I want to get into a couple of your picks. You talked to me earlier about McGraw-Hill. They've announced this potential split up. Why do you like it?
Well, number one, I guess from the standpoint of regulatory concerns related to S&P, that seems to be receding. You know, that kind of kept the stock cheap. Moody's, in fact, has done quite a bit better. But yeah, the breakup, I think that's a way of unlocking some of that value potentially.
All right, and how high does it go?
Oh, I've never been one to really put a price target on that.
Well, a couple of guys are saying $55. It's in the mid-40s right now.
Yeah, well, that's
$10. Can you make $10 on McGraw-Hill?
I think absolutely. I think it could go higher. I think it could certainly go higher than
into
that.
the 60s.
Absolutely.
All right, talk to me about one of your other picks.
Well, EMC been crushed lately.
Software.
This is a pretty good entry point, I think. They have a big stake in VMware, which has really been moving along, and EMC as a whole is really well positioned from the cloud. I mean, storage for the cloud. This is going to be a theme that we're going to hear quite a bit going forward.
You know, the cloud was so hyped, everyone was talking about it a year ago, 6 months ago. Has it run its course? I mean, some of the names up, a few 100%.
Well, yeah, absolutely. I think EMC, though, it's going to be one of these bigger cap companies that's going to have some staying power going forward.
Hey, Rob, I'm listening to you talk about your picks. So safe to say that you've been out there aggressively buying because valuations have been beaten down so much. I mean, they could certainly go down more, as we've seen throughout the week.
Sure.
But are you out there aggressively buying at this point?
I would say buying on the dips is probably more appropriate as opposed to aggressively buying. Maybe it's semantics, but yeah, I'd say buying on the dips.
Well,
and we've had some dips in these names, that's for sure.
Well, that's what I mean. I mean, we have seen tremendous dips this week. We're down more than 7% on the S&P 500. So, I mean, are you just cherry picking what those big those big nationals, multinationals, excuse me, or what?
Absolutely. Yeah, I'd say the overall macro theme would be to be in the large cap, dividend paying domestic growth stocks, underweighting small cap, underweighting international, and that in general would be a theme here.
All right, Give me another pick.
Financials, MasterCard. Not a huge fan of the banks right now, but MasterCard, consumer spending, with the exception of personal spending earlier this week, consumer spending has been consistently beating pretty low expectations.
And delinquencies are down.
Delinquencies are down. MasterCard, too, one thing that separates them from the other card companies, 50% of revenues are from overseas, once again. And we're seeing personal spending or consumer spending be even more there. So when that happens, people use their credit card more than expected. MasterCard looks attractive.
I got to ask you about Bank of America. Bank of America got into the low 8s. It's trading at less than half times book. Obviously, people don't believe book. Can you get excited at all about the banks, or is it a black hole?
I do think the banks are going to fix their balance sheets sometime in 2012, and of course the stocks will anticipate that. I think it's still maybe a little early right now, but at some point those big banks are going to look attractive. So
you're not buying them now?
Not right now, no.
Were you actually buying today?
Sure, yeah. I'd say buying on the dips that has been a theme of ours, and today we definitely got that in spades.
Is there anything you want to lighten up on? Anything that just doesn't feel good?
Well, I tell you, there's been such this flight to safety. Utilities, consumer staples, those sectors, the traditional defensive sectors, they're starting to look pretty expensive right now, given the earnings growth. It's just been this flight to safety.
Bonds are probably looking expensive too, right?
Bonds are looking expensive.
Yield on the 10-year
at
240?
Bonds are definitely looking expensive.
All right, Rob Morgan, Fulcrum Securities, thank you for joining us, sir.
Thanks, Adam.